Hey, I'm Dan Pascone, CEO of Tailored Wealth and host of the Making Sense of Your Money podcast, real conversations to help high earners make sharper decisions so their money works as hard as they do. This is episode number 54, and this is a rare solo episode, which came straight from listener requests. And today I'm breaking down employer retirement plan contributions, the 3 different investment tax buckets, and how strategies like the mega backdoor Roth can help high earners increase retirement savings and build more future tax-free flexibility. Before we dive in, make sure you're subscribed on your favorite platform. And if you find the show valuable, I'd really appreciate you leaving a quick review. Thanks so much and enjoy.
Brought to you by Tailored Wealth, helping business leaders live their version of a rich life.
Welcome to another edition of the Making Sense of Your Money podcast, where we cut through the financial noise and help business leaders to make smart, confident money decisions. All right, I'm solo today, which is going to be a bit lonely, but we have some amazing guests coming up on the Making Sense of Your Money podcast. And this is one that I've been asked to do by several connections, followers, clients, because it's a very busy time of year in the financial planning calendar. So I'm going to do this one today all around employer retirement plan contributions. Many folks are revisiting that or have revisited that, hopefully. And then I'm going to do another one after April 15th around tax planning, so we can help you to reduce your taxes for 2026 and beyond. Because if you're like many of the new prospective clients that come to us, you probably look at your tax bill from last year and say, how did I pay that much? How can we make it less? So we'll do that in a future episode. But today's going to be all about employer retirement plan contributions. So this is a time of year when probably a bonus has been paid out. Probably if you got a raise or a cost of living adjustment, that's been put in place. So it's a great time to revisit, how are you contributing to your employer retirement plans? So we'll start off by just some basics. And we'll start off with the basics of the 3 tax buckets when it comes to investment. Okay. And then we'll relate that to how that fits within your retirement plans. So first off, you've got your taxable accounts. Your taxable accounts is anything that has already been taxed that you're contributing to either a savings account or a brokerage account, or you're putting to work in some other form of action. But the money's already been taxed, and generally the growth is taxed. The second bucket is the tax-deferred account. Those are your 401ks and IRAs where the money goes in pre-tax, grows tax-deferred, but then gets taxed on its way out. So whenever you take income from it, usually in retirement, you're taxed on those dollars. The third is the future tax-free bucket, and that's the, generally speaking, the Roth account. We can also throw other accounts like HSAs, health savings accounts, or 529 plans into this bucket. But for the sake of today's discussion, we're really going to focus on your Roth options within the 401k, and then your Roth IRAs. And again, the concept with that is the money's already been taxed, so you pay taxes on it when it's earned. Then it goes in and grows tax-free and can be withdrawn in retirement typically without paying taxes on it. So it's sort of the opposite of the IRA or traditional 401k. It's the Roth IRA or Roth 401. So let's talk about how this fits within your company retirement plans. Okay. Let's take taxable out of the discussion for a minute, even though it does impact kind of how you think about where you're saving into. But generally speaking, with most professionals that work for organizations that offer a 401k, you are likely going to start with the traditional 401k contribution. That's your pre-tax contribution that goes in. And in many cases, the employer is going to give you a match. It might be up to 4%. It might be up to 5%. It might be up to 6%. It might be 100% on the first 3% and then 50% on the next 3%. That's a pretty traditional structure these days. But regardless, you're putting money in pre-tax and the company is matching it. Okay. The second option, which many employers, most actually these days offer, is the Roth 401k. The Roth 401k means the money gets taxed, it goes in, it grows tax-free. There are ways to structure the match on that portion as well, but typically most folks that come to us are getting their match on the pre-tax portion. Okay. And then many plans, but not all of them offer a third bucket. And this is the one that not most folks know about, or they may know about it, but they don't know how to execute it. And that is after-tax contributions to the 401k. And those don't sit in the traditional or the Roth. They sit in this third bucket. And this is the strategy that is commonly referred to as the mega backdoor Roth. Okay. Different than the backdoor Roth IRA. Backdoor Roth IRA is just contributing to an IRA and then converting it to a Roth and paying the taxes on the spot. That works for folks that make too much money to contribute to a Roth IRA, but you can only do it in a limited capacity per year. For most folks, that's going to be between 7,000 to 8,000, depending on your age for 2026. The mega backdoor Roth allows for, if plan allows it, a lot more to be contributed in after-tax dollars, but future Roth dollars, which can be a very, very powerful planning mechanism. So the way that works is you contribute into that third bucket, the after-tax contributions, and then you immediately convert that into the Roth account. Okay. So why would you do that? Why not just contribute to the Roth? Okay. If I already have that option. Well, it's all about capacity. Okay. So for 2026, you can contribute 24,000 for the traditional 401k. All right. Individuals that are 50 and older are able to do an additional 8,000. And that has to, in 2026 anyways, this may change, but that has to go into the Roth 401k bucket. Okay. But on its surface, that's the max you can do. There's an additional contribution area of between 60 and 64, but I'm going to stay away from that for today's discussion. Okay. An individual under 50 can do the 24,500. Over 50, you can do 1,500, but that additional 8 needs to go to the Roth bucket. Okay. Now, the total IRS capacity, the total contribution limit, if you will, for 2026 is actually not the 24,500 or even the 32,500 with the catch up. It's actually 72,000. So you have a lot of additional bandwidth. But the caveat is you can't do any more into the traditional 401k or Roth. So it has to be done in after-tax contributions. Okay. So for higher earning professionals that have enough savings and have specific retirement goals, this can be a very, very powerful tool because you can get a lot more in additional contribution capacity into your 401k. So here's how the math works out. I'm going to actually grab my phone so I don't mess the math up here. But here's how the math works out if you want to essentially maximize your tax deferred contributions, right? Being it pre-tax and after tax, but it all grows tax deferred. You could contribute 24,000 401k. If you're over 50, you add 8,000 to that. But the 8,000 doesn't count toward the $72,000 cap. Okay. So let's just say it's 24,500. And then what you need to do is you need to add the company's contribution. So I was speaking with a client yesterday, actually, and her company was matching up to, I believe it was 6%. And that ended up being an additional 9,000. So here's how the math worked out for us. 24,500 plus 9,000 got her to 33,500. So she was maxing that out. She was actually putting an additional 8 on top of that, but we'll come back to that later. So 33,500. And then we looked and said, okay, the total capacity for the year is 72,000. So you subtract the 33,500 and you get to an additional capacity of 38,500. So because she's a higher earner, because they have additional savings, and because they have dedicated retirement goals that they're working towards, we are going to try to fill up that additional 38,500 in capacity with after-tax contributions. With the key being that once we contribute that, we need to have a mechanism to automatically get it converting to the Roth. Because if you just let after-tax contributions sit in the 401k, any gains are taxable. So many employer plans, and a lot of folks don't know this, especially the bigger companies, are seeing this as a loophole, but it's It's a loophole that is widely accepted by the IRS, and most folks know about it today. So it's now seen by organizations as a perk. So a perk of the 401k would be that they allow for automated after-tax contributions to be converted to the Roth. So in this case, we would contribute each paycheck, and you have to back into what contribution percentage or dollar amount you want to do each paycheck, so that you're essentially going to get right up to that 72,000, but not over it. Okay, that's where the real planning and the organization and the sort of the orchestration of this option comes in. So for her, it was around $2,000 a paycheck. And what we did was we set that up now, and we'll let that run until the fourth quarter. And when we do our review in the fourth quarter, we'll check to see where we're at from a capacity perspective. Okay, because sometimes some additional employer contributions could bump that number up. So you want to make sure you don't go over it. But it's a great planning opportunity and review opportunity for Q4. So that additional $38,500, that is money that can be pumped into a Roth, grow tax deferred, and be accessed tax free down the road, which you wouldn't otherwise have the ability to contribute to if you didn't use this mega backdoor Roth strategy, which is why I love this strategy. And I'm getting a little amped up and excited here because it's such a great strategy for corporate leaders that their plan allows for it, and they want to, what I call, tax diversify. So they want to be able to have diversification between the taxable, tax deferred, and future tax free buckets in retirement. And why the Roth is so powerful here is because that is money that you have building tax deferred and you can access tax free in the future, right? So what we often see is in retirement, folks want to make large purchases. Well, when you're making a large purchase, you want to buy a vacation home, you want to buy a boat, you want to have a big trip that you take. Do you want to actually pay taxes on that money? So essentially, depending on what your tax rate is in retirement, which is usually higher than you think it's going to be, especially because tax rates are likely to go up in the future. Do you want to pay anywhere between 10 to 30% on that purchase? Well, no, that doesn't sound as fun as, just buying the vacation home or buying the boat or buying the expensive vacation and not having to pay that tax on it, right? So the Roth bucket gives you a lot of optionality in retirement from a tax efficient distribution perspective. But I like it because it allows you a nice pocket of money that you could dip into for a large purchase in the future. And for most high earners, they don't have the ability to contribute meaningfully to a Roth. They can do it in the traditional backdoor Roth IRA, and they can do it in their Roth 401k. But those are limited as far as the contributions are concerned. You can get a lot more bandwidth if you're contributing in the after-tax portion and using that mega backdoor Roth. So again, the components would be figure out how much you're contributing to the traditional, if you're maxing it out at $24,500. Figure out how much your employer is matching on top of that. Add those two numbers together and subtract it from 72,000. That is your capacity to contribute after tax, and then have that automatically converted to the Roth. There is a second mechanism that allows you to take proportionate distributions from the 401k and then automatically have those converted into your Roth IRA and traditional IRA. That's a little bit more cumbersome, but it is a way to do it. And so the question there would be, do you allow for in-service distributions? Whereas the initial strategy that I mentioned is the question to ask your employee benefits team or your 401k platform is, do you allow automatic conversion of my after-tax contribution? So I had a couple that we met with last week that we were setting this up for, and her plan allowed for it and his plan didn't. And what he did was he went to his benefits team and said, can we get this option? And it prompted them, it's a smaller company, but it prompted them to look at that feature for their employee base because it's a really nice perk and it's a great savings vehicle. So in a nutshell, that's the mega backdoor Roth. Again, you've got the traditional 401k contribution. You've got the Roth 401k contribution, which can go up to $24,500, a combination of those two, plus the additional 8 if you're over 50. Okay. And then you've got all this additional bandwidth to go into the after-tax portion. So the question I often get is, well, how do I decide which buckets I want to use. You've got these three different buckets. How do I decide which ones I want to use? From a retirement perspective, I always, the financial plan is going to dictate that, right? Your tax rates today, your projected tax rates in the future, when you want to retire, if you need a bridge, if you're going to retire before 59 and a half, if you need a bridge between, your investment, your taxable investment accounts and your retirement accounts that can be accessed at age 59 and a half. Well, those will all impact what goes into each bucket. But I had someone ask me this question, which is a common misperception last week. And when I was talking to him about this mega backdoor Roth strategy, what he said was, well, why would I pay the taxes today on the mega backdoor Roth, because the money gets taxed before it goes in there, where my tax rate in the future is going to be lower? Why would I not just contribute and optimize the pre-tax and the traditional 401k? And my answer to him was, well, that's actually the wrong question. Because what we're not asking you to do here is decide, do I want to pay taxes today versus do I want to pay taxes in the future? We are already maximizing the traditional 401k in this situation. And again, this is all for folks that have the bandwidth, have the savings capacity, and are working toward retirement goals. If your goals are different and you need more liquidity in your investment accounts, taxable accounts provide that, whereas retirement accounts don't. But if you're trying to optimize your retirement, the mega backdoor Roth is a great strategy. And we're not asking you not to optimize and max out the traditional 401k. We're just saying that instead of contributing in the scenario that I just gave you, 38,500 to a taxable account where the money is going to be taxed on its growth and the money is going to be taxed when it comes out, contribute that to the after-tax portion of your 401k and convert it to the Roth, because then you're going to take advantage of tax-deferred growth and tax-free distributions in the future. Okay. So those are the three buckets. My suggestion is always revisit your financial plan in Q1. Usually toward the back end of Q1 is when we're doing our reviews for the first quarter of the year, because we have a general idea of what your bonus might look like from the prior year, if there's any raise, and we can revisit those retirement contributions and ensure that we're optimizing them. But if you've got the bandwidth and your goal is to save for retirement, max out the traditional 401k first, add the 8,000 in Roth 401k if you're over 50. If you're not over 50, you could split that 24,500 between the traditional and the Roth 401k. And that's all going to depend on what your current mix is and what your retirement age looks like. So I'm not going to make any suggestions on that because that is unique and different to each client situation. Do consider and engage your employer and ask them if that third bucket is available for you. Do you allow the questions that you want to ask are, do you allow after-tax contributions to the 401k? And if so, do you A, offer automatic conversions to the Roth, which is ideal, and many plans do allow that. What you typically have to do is you have to call the 401k platform. So whether it be Fidelity or Vanguard or Empower, you have to call them and just turn this function on. We've done a number of them in the first quarter. And then the second option, if they don't allow for that, would be, do you allow in-service distributions, meaning we can take money out of the 401k without penalty on a systematic basis. And that will allow us to do the conversion outside of the plan and directly into your Roth IRA in this case. But there's a pro rata rule. I'm not going to get into that for the sake of today's podcast because it's a bit technical. I don't want to throw you off. And again, this isn't investment or savings advice. It's just letting you know the various vehicles that you have at your disposal from a retirement plan perspective. So those are the three vehicles. Those are the things that I would consider. And again, each client situation is unique and different, but I've been asked this question a lot over the course of the last month or so. So I wanted to do an individual podcast on it. I'll come back to do another one on some tax planning ideas and concepts that you should be thinking about to lower your tax bill in 2026 and beyond in future weeks. Hopefully you enjoyed this and appreciate you listening and following Sense of Your Money. Cheers.